Hello guys and welcome to another deep value video. Today taking an in-depth look at analog devices and Carvana Co. Analog Devices is an American multinational semiconductor company specializing in data conversion, signal processing, and power management technology. First of all, we'll start with their free cash flow, which is 2. Free cash flow yield, sorry, which is 2.74%, and their price to earnings is 65, both suggesting a high valuation. Their stock price has moderately increased over the past year, and their business metrics also they look okay. Their current ratio looks pretty good at 1.83, so they have good short-term liquidity, but they have a low ROIC of 4% and a low return on equity of 4.6%. Next, let's do Graham's valuation using the 2025 estimated earnings per share. We get an intrinsic value of $166.85. Next, we'll go to the discounted cash flow. We can see that their free cash flow has increased considerably from 2015, and of course it's declined in the past 2 years, but I'll put in a 6.5% growth rate, which is well below their historical average. And using a 8% margin of safety, we get an intrinsic value of $126 per share. Next, let's move on to the dividend discount model using a 6% growth rate, so close to their free cash flow growth. We get an intrinsic value of $195. Next, we'll find the output, which is an average of all these three, and the intrinsic value is $162. But the current price is 214, so they're trading well above their intrinsic value. And of course, if we want to apply 15% margin of safety, we get an acceptable buy price of $138.3. So there is a long way from the current prices to a zone to a price where I think this could actually be a buy. It's not a bad company, but they're just not trading at low enough valuations yet. Yeah, and the next we have Carvana. Carvana is an interesting company. Their free cash flow yield is 12.47, so they're trading at a great valuation. The price to earnings is negative because they've had negative earnings. The return on equity is 185%, but of course, this is because of a short-term problem. We should mostly focus on the free cash flow because this is what matters. As for Graham's valuation, let's see their let me check their 2024, 25, 1.84 earnings per share, intrinsic value of $34.7. Next to DCF, well, their free cash flow was negative a lot of time, and now it's been positive. I'll just let it at a 10% growth rate. Or actually, no, I think 10% because they're becoming profitable. But to be honest, I'm not sure how profitable they can become since they've been operating since 2014, and we see that they've not broken even for most of that time. I'll just put in a 10% growth rate, and because they're a much riskier company than initial, I'll just put in a 9% discount rate. We get a price per share of $296. Moving on to the dividend discount model, we jump it because they do not give out a dividend, and uh, the average of these two is $65. The current price being $285, thus giving us an total buy price of $55.59. So they're trading well above their current price. I'm not sure this is necessarily a bad company. Let's look at the business metrics for a second. We can see that their current ratio is 2.16, so very good liquidity. Their cash per share is 8.2. Yeah, I think their valuation, return on equity, I think their valuation would be much better. If they drop to 180, 170, because I think this is a bit of a low valuation. I think that they might actually grow much more than 10% per year in terms of discount, in terms of free cash flow. Yeah, but the problem with these types of companies is that if they grow too much, if they, sorry, not grow too much, but if they um, are too risky in a high growth industry, in an industry that grows a lot, but it's not necessarily profitable, then you may never know how profitable they may be. So, for example, let's take a look at Uber, a sort of adjacent business that Uber has been profitable, but those profit margins do not really spark happiness in any investor's eyes. I mean, you really want higher margins than 2-3%. Realistically speaking, they can't even get that much because if they price out their drivers compared to taxis, then nobody will use Uber. And for Caravana, it's a similar business in the sense that they, being a second-hand retailer or a used car retailer, is not necessarily a business that has a monopoly on anything. They do not have a monopoly on the used car business, so they can easily get priced out by others. They can't put their prices too high. They're sort of a slave to the car prices. Yeah, I'm not sure if they're in the greatest of all businesses, so this is why I put 10%. But as I was saying, they're extremely overvalued. I would warn you against investing in them, but of course, do your own due diligence. Yeah, do not forget to check out our affiliate for today, Tickerita. Tickerita is the tool I use today. So with all of this template, with the ticker symbol, with the real-time financial data, this is ticker data. It's a great tool. I recommend you use it. Yeah, also do not forget to check out my blog from the link in the description below. And I hope to see you in the next video. Bye.